Today, we are tackling a real corporate finance mystery, something that was, for all intents and purposes, dead and buried.
We're talking about the stock split. It's this maneuver where a company basically slices its shares into smaller, cheaper pieces. So one share worth $1,000 might become, say, 10 shares worth $100 each.
And for over a decade, it was considered almost obsolete, an artifact of a different time in the market. If you look at the numbers, splits were just in a free fall after 2000, and they hit this incredible low point of just 6 splits in 2009.
Exactly. The reasons for their decline were solid. And yet all of a sudden, we see these huge high-profile tech firms, Apple, Tesla, Amazon, Google, they're all doing it again.
Which brings us to the central puzzle. I mean, if you, the listener, can just log into your trading app right now and buy a fractional share, a tiny piece of a $3,000 Amazon stock, why on earth would Amazon bother splitting it? The old logic just doesn't hold up.
And that is our mission for this deep dive. We're here to unpack a new theory, that the modern stock split isn't what it used to be. It's no longer just about trading mechanic.
It's evolved. It's now this powerful, what the research calls a dual-purpose attention catalyst.
A dual-purpose catalyst, meaning it's designed to attract not just investors, but, and this is the key part, customers as well.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Yeah, and to really get it, we have to go back to the beginning. We need to understand the old world, the traditional reasons for splitting a stock.
Okay, let's do that. So before this practice nearly died out, what was the standard rationale? Why would a company do this 25, 30 years ago?
Well, there were two big ideas. The first and most common one was something called the trading range or the anchoring hypothesis.
Anchoring, so like a psychological thing.
Exactly. The thinking was that there's a sort of comfortable price range for a stock, maybe between $20 and $100. If it got much higher than that, it just felt too expensive for the average retail investor.
Even if they could afford it, the sticker price was off-putting.
Right. It was basically a marketing move to keep the price looking attractive. The second idea was what's called the informational signaling hypothesis.
Okay, signaling what?
Confidence. Splitting a stock isn't free, it's a hassle. So when management announced a split, they were essentially telling the market, we are so confident in our future growth that this stock is going to be right back up at $1,000 soon, so we're splitting it now.
And there's data to back that up, right? That it was a positive signal.
Oh, absolutely. Studies found that, historically, split stocks tended to outperform the market by about 8% or even more in the year after the split.
So it was a credible, costly signal of financial health. But then the world changed. Our source material points to a couple of huge shifts that really just eroded those reasons.
The first one was the rise of institutional ownership. Huge mutual funds, pension funds, hedge funds, they started to dominate trading.
And they don't care if a stock is $50 or $5,000.
Not at all. They're trading in massive blocks and have the capital. The psychological appeal to the little guy just mattered less and less.
And the second shift, which is more on the technical side, was decimalization.
Right. A huge one. In 2001, U.S. markets switched from pricing stocks in fractions like eighths and sixteenths to decimals.
Which made the bid-ask spread the gap between the buying and selling price much, much smaller.
Exactly. And that basically wiped out one of the main microstructure benefits of splitting. There was just less of a financial incentive to do it.
So splits declined, they nearly vanished, but then the environment changed again. And this is where we get to the turning point, 2008.
The period right after the financial crisis completely transformed retail investing. This was the birth of the attention economy, but applied directly to the stock market.
You've got the rise of commission-free trading. Mobile apps like Robinhood become ubiquitous. And then there's the explosion of financial talk on social media, Reddit, X, everywhere.
All the friction to trading just disappeared. And suddenly, the most valuable currency wasn't commissions, it was attention.
And in that kind of world, a stock split is. It's like a perfect marketing event. It's low cost, it generates a ton of media coverage, it trends online.
And crucially, it sends an immediate notification to millions of users on brokerage apps who have that stock on their watch list. It's a huge coordinated alert.
Which is the engine for this dual-purpose catalyst idea. It grabs the attention of retail investors, who we know are drawn to these high-profile events, and it captures the attention of potential customers.
Right. The research has shown for a while that high firm visibility can boost how customers see you, and that can actually drive sales. The split becomes this viral moment where your company's name is just everywhere, linked to this idea of success.
That's a powerful theory. But, proving that a stock split actually makes more people buy iPhones or shop on Amazon, that's a big claim. So let's get into the data. What's the evidence this actually works?
Okay, so first you have to show that splits still do the old job, which is improving liquidity, making the stock easier to trade. And the research confirms they absolutely do.
But how do we know that's from attention and not just, the lower price making things work better mechanically?
That's a great question. The research uses a couple of key indicators. First is something called the Amihud illiquidity measure.
Okay, that sounds pretty technical. In plain English, what's that telling us?
Think of it like this. It's measuring the cost of trading. How much does the price move if you try to buy or sell a bunch of shares? A high score means the stock is really illiquid. The price moves a lot on you.
So a lower number is what you want. Higher liquidity.
A lower number is much better. And the research finds this measure drops significantly right after a split. The stock gets easier and cheaper to trade.
And they confirm that with the bid-ask spread, too.
They do. The spread between the bid and ask price gets significantly smaller. So yes, splits still improve liquidity. They are still attracting investor attention and trading.
Okay, so that's the investor side. Now for the really new part, the customer side. If this is truly a dual-purpose catalyst, does that attention actually translate into sales?
It does, and this is probably the most fascinating new finding in the research. They tracked firms' quarterly net sales, and they found that sales increased significantly after a stock split.
That's incredible. A company makes a financial announcement, and their sales go up. It's like a free advertising campaign.
It's free advertising with this implied stamp of success. The buzz around the split seems to boost customer confidence and interest in the company's products. For a consumer-facing company like an Apple or an Amazon, this isn't just a financial decision, it's a marketing one.
So that brings us to the paradox, then. If splits work by getting attention, who benefits the most? Is it the huge companies that are already famous, or is it the smaller firms that really need the spotlight?
Well, when you look at the whole sample, going from 1984 to 2021, the data is pretty clear. Smaller firms and firms with less institutional ownership benefit significantly more.
From both the liquidity boost and the sales growth.
From both, which makes perfect sense, right? If you're a small consumer tech company, a sudden blast of positive media attention from a split is going to move the needle on your sales way more than it would for a giant like Google.
The relative benefit is much bigger for them. Which brings us right back to the puzzle. If that's true, why are the mega caps, the Teslas and the Googles, the ones leading this new wave of splits?
Because they're not playing the same game. They're not chasing relative gains. They are chasing the absolute volume of retail investors.
Acquiring new individual shareholders.
Exactly. And to prove this, the research has to go deeper than standard liquidity metrics. They use this incredibly detailed trading data. It's called TAQ data. TAQ stands for trade, end quote. It's like the highest resolution X-ray you can get of trading activity. It lets you see the size and frequency of every single trade.
Which means you can tell the difference between a huge institutional block trade and the smaller, more frequent trades that are typical of a retail investor.
Precisely. And using that data, what they find is that after a split, retail trading just explodes. Both retail buying and selling, in terms of volume and frequency, increase significantly.
So the split definitely pulls in the retail crowd. But here's the nuance. It doesn't pull them in equally for all firms.
Not at all. This is the key. That positive increase in retail trading is significantly more pronounced for the large market cap firms and the high institutionally owned firms.
So a huge company like Apple sees its retail buy frequency jump much, much more than a smaller companies would.
Way more. The mega caps are just exceptionally good at converting that media buzz into a massive influx of individual traders.
This all points to a fundamental shift. To really see it, we have to compare the two eras directly. Pre-2008 versus post-2008.
Let's start with liquidity. Before 2008, the liquidity effects were pretty strong across the board. That was kind of the main point of doing a split back then.
But after 2008, in this new attention-driven world,
the benefit gets much more selective. In the post-2008 period, the liquidity effect is only statistically significant for large firms and high institutionally owned firms.
That's fascinating. So for a small company now, the liquidity argument for splitting has kind of faded away.
It seems to have. I mean, with fractional shares being so common, retail traders can get in anyway. But for the big firms, the massive wave of retail attention they generate still seems to tighten their spreads and improve their trading environment.
Okay, now for the customer side. If this is really about attention, the sales bump should be way stronger in the social media era.
And it is. This is where the difference is just night and day. The sales growth effect is significantly more pronounced in the post-2008 period. Before then, it was barely even significant. The link between stock market buzz and actual sales has become incredibly tight.
And who's best at capitalizing on that now?
Again, it's the large firms. In the recent period, that sales growth effect is statistically significant only for the big, well-known companies.
So their brand recognition acts like a massive amplifier for the buzz created by the split.
It seems so. They can convert that attention into customers more effectively than anyone else.
Okay, so speaking of buzz, let's talk about the immediate market reaction. The announcement happens. What does the research say about how investors react in the short term?
The market loves it right away. If you look at that short window, 3 days before to 3 days after the announcement, there's a cumulative abnormal return of about 1%.
And a 1% abnormal return is significant. The market is cheering.
Definitely. But the cheers are louder for some than for others. The short-term pop is significantly higher for small firms, around 1.5%, and for low institutionally owned firms, where it's closer to 2%.
Which makes sense. For a smaller, lesser-known company, the news carries more weight. It's a stronger signal of management's confidence.
Exactly. For a company like Amazon, it might only be about 0.5%. The news is less surprising.
What about the longer-term picture? Historically, we know split stocks tended to outperform.
They did. Over a 2-year period, those returns were positive, and they were mainly driven by those same small, low IO firms, the ones who really needed the signal and the liquidity.
But let me guess, in the post-2008 world, that script gets flipped too.
It does. In the modern sample, the analysis shows that only large firms have statistically significant long-term positive returns.
So the market seems to be rewarding the biggest players for using this tool strategically in the new attention economy, believing they can turn that retail engagement into lasting value.
It's just a completely different tool than it was 20 years ago. It's evolved from a simple mechanical fix into this complex, strategic play for visibility.
So to synthesize this for everyone listening, what this all means is that the return of the stock split isn't some retro trend. It's a very modern adaptation to this new social media-driven investing world.
Right. Splits are now strategic attention catalysts. They still boost liquidity, but they also drive real sales, and that sales effect is much, much stronger in the post-2008 era.
And while the smaller firms might get the biggest relative bang for their buck, the mega caps, your Apples, your Amazons, are splitting because they are just incredibly effective at converting that attention into a massive volume of new retail investors.
Which leaves us with that final, really provocative question to think about.
If fractional trading makes high-priced stocks accessible to everyone, and the biggest relative gains go to the smaller firms, why are these massive institutionally owned companies making this a priority?
And the research offers a really compelling possibility, that the value they're after is deeper than just trading.
Something beyond liquidity.
Yeah. They seem willing to undertake this process just to maximize their number of retail shareholders, maybe for branding, maybe for better customer engagement, or maybe even for the subtle governance effects that come from having millions of small, engaged owners.
So the share price itself, the nominal number, has become a strategic asset in the battle for attention.
It seems so. A fascinating intersection of finance and marketing.
It really is.